अभी रीराइट करता हूँ स्ट्रॉन्ग हुक 3,3200 words एंड में सिर्फ Retirement Rights Canada. If you are a Canadian senior over the age of 60 and you have money in a bank account, in a savings account, or even in cash at home right now, something is happening in 2026 that you need to understand immediately. The rules governing how you access, withdraw, deposit, and hold your own money have changed in ways that most Canadians have not been told about clearly or completely. Your CPP payments, your OAS, your GIS, your RRIF, all of it is affected by a set of shifting regulations that are creating real consequences for real seniors right now. This is not speculation. This is not designed to alarm you unnecessarily. This is the honest, complete picture of what is happening, why it matters to your monthly income, and exactly what steps to take to protect yourself before any of this affects you directly. Stay with me until the end, because the action plan at the close of this is the most important part. The law that changed the rules around cash. In June 2025, the federal government introduced Bill C-100, known as the Strong Borders Act, which brought sweeping changes to Canada's anti-money laundering legislation. While the government framed this as a measure to combat financial crime, the real-world consequences for ordinary seniors have been significant and largely unreported by mainstream media. Among the key provisions, the legislation makes it an offense for any person or entity engaged in business or charitable activity to accept a cash payment of $10,000 or more in a single or related series of transactions. A related proposed regulation goes further, introducing a blanket restriction on all third-party cash deposits, meaning someone depositing cash into your account on your behalf, regardless of the amount, with only limited exceptions. Think carefully about what that means in everyday life. A grandmother in Mississauga who receives a small amount of cash from her adult children each month to help cover groceries and medication. A grandfather in Calgary whose son stops by every few weeks and deposits a little cash directly into his father's account to help make ends meet. These are not criminal transactions. These are families taking care of each other. But under these proposed rules, these kinds of deposits could be flagged or prohibited entirely. The broader effect of this legislation on the banking system has also been significant. Banks and businesses now face administrative penalties described as unprecedented in the Canadian financial services sector, with potential fines reaching $30 million or 3% of gross global revenue for non-compliance. When financial institutions face penalties that severe for accepting certain cash transactions, their rational response is to refuse cash more frequently, ask more intrusive questions, and create more barriers between customers and their own funds. The burden of those barriers falls heaviest on those least equipped to navigate digital alternatives, and that means seniors. Why this hits seniors? Hardest many older Canadians, particularly those in their 70s and 80s, did not grow up with digital banking, online transfers, or mobile payment applications. They are not comfortable with e-transfers and apps. They trust the physical reality of cash in their wallet. And that is not a character flaw. That is a legitimate, time-tested approach to managing money that the government now appears to be systematically dismantling. Cash provides people with what financial economists call a hard budget. With cash, you can only spend whatever you have on you at that moment. For seniors living on fixed incomes, this is not just a philosophical preference. It is a genuine, practical tool for managing finances responsibly and staying within their means. Think about the senior in rural Nova Scotia who drives 45 minutes to the nearest bank branch and needs to withdraw cash to pay a local tradesperson who does not accept digital payments. Think about the elderly couple in Saskatchewan who have always contributed to their grandchildren's education in cash because it feels more personal and meaningful. Think about the widow in Ontario who was taught her entire life to keep some emergency cash at home because power outages happen and ATM machines stop working. These are not edge cases. These are the lived financial realities of hundreds of thousands of Canadian seniors, and the new regulatory environment is treating those realities as suspicious. There is also the quiet erosion of trust that comes with being treated as a potential financial suspect simply for trying to access your own money. When you were working, no one questioned you when you went to the bank to withdraw your paycheck in cash. No one asked you to justify why you preferred physical money over digital transfers. No one made you feel like a criminal for wanting to hold your own money in your own hands. But these new rules create an environment where ordinary financial behavior, the kind that seniors have relied upon their entire lives, can suddenly trigger reporting requirements, compliance reviews, delays, and restrictions that feel deeply disrespectful of a lifetime of honest financial conduct. The RRIF problem that is quietly draining retirement savings. The cash rules are only one part of the financial pressure building on Canadian seniors right now. There is a second issue that has been quietly escalating for years and is reaching a breaking point, and it involves your registered retirement income fund and the mandatory withdrawal rules that govern it. If you have an RRSP and you are turning 71 this year, this applies to you directly, and the deadline is not flexible. Once your RRSP is converted into a RRIF, the government requires you to begin withdrawing a minimum amount of money every single year for the rest of your life, whether you need that money or not. At age 71, the prescribed minimum withdrawal rate from a RRIF is 5.28% of the account's total value. By age 80, that rate rises to 6.82%. By age 90, it reaches 11.92%. These percentages were established decades ago, based on assumptions about life expectancy that no longer reflect reality. When registered plan reform took place in the early 1990s, life expectancy at age 71 was approximately 13.7 years. Today, life expectancy in Canada has reached 83.26 years, and research shows that 14% of Canadians will reach the age of 95, a dramatic increase from just 5.6% in the 1980s. The government's withdrawal formula was designed for a world where people were expected to die much sooner than most Canadians today will. The cruel mathematical consequence is that the longer you live, the more aggressively you are required to drain your savings. Imagine being 88 years old. Your RRIF has been steadily reduced by mandatory withdrawals for nearly 2 decades. And now the government is requiring you to pull out almost 12% of whatever remains every single year. Money you may desperately need to preserve for the years still ahead of you. Organizations including CARP, the Canadian Association of Retired Persons, have been advocating strongly on this issue. Their position is clear. Mandatory RRIF withdrawals do not just inconvenience seniors, they jeopardize financial security. And because the government collects tax on those withdrawals regardless of when they happen, there is no genuine fiscal reason to impose this forced drainage during a person's lifetime. The tax revenue will be collected eventually, but the financial security of the senior being forced to withdraw it may not survive the wait. How RRIF withdrawals connect directly to your OS. Every dollar you are forced to withdraw from your RRIF becomes taxable income. That matters enormously because it counts toward your total annual income, which the Canada Revenue Agency then uses to determine how much old age security you are entitled to receive. The connection is direct, automatic, and catches many seniors completely off guard. For 2026, the OAS clawback begins when your net world income exceeds $93,454. For every dollar above that threshold, 15 cents is clawed back from your OAS payments. For seniors aged 65 to 74, OAS is fully eliminated when income reaches $154,753. For seniors aged 75 and over, the upper threshold is $160,696. You do not need to be anywhere near the upper thresholds to feel the impact. A single unexpected financial event, the sale of a property, an inheritance, a one-time spike in investment income, or a forced RRIF withdrawal that pushes your income just past the minimum threshold, can cost you hundreds or even thousands of dollars in lost OAS benefits that year. There is no warning letter. There is just a smaller deposit in your bank account the following month. Consider a realistic example. A modest retiree living on CPP, OAS, and withdrawals from a small RRIF sells a rental property. The income from that sale pushes their total annual income to $99,000. That modest overage immediately triggers the clawback, reducing their OAS by nearly $1,200 over the following year. They did nothing wrong. They made a reasonable financial decision, and they were penalized for it in a way they never anticipated and were never warned about. This is the reality that financial commentators have called the hidden clawback accelerator. The forced RRF withdrawal rules and the OAS clawback rules interact in ways that systematically erode retirement income. And the new cash restrictions add yet another layer of complexity and stress to an already difficult situation for Canadian seniors navigating fixed incomes in an increasingly complicated financial environment. What the new rules mean for everyday financial freedom, Canada has always prided itself on respecting personal freedom and financial autonomy. Every Bank of Canada bill carries the declaration that it is legal tender. Critics of the new legislation have argued powerfully that restricting cash transactions so aggressively directly contradicts that foundational promise. The philosophical shift this represents is significant, and the practical consequences fall disproportionately on older Canadians who built their financial lives around a system that is now being fundamentally restructured without adequate notice, explanation, or transition support for those most affected by the changes. The ripple effects extend into everyday practical situations that may not be immediately obvious. A senior in rural Nova Scotia paying a tradesperson in cash. An elderly couple marking a grandchild's milestone with a cash gift that carries personal meaning. A widow keeping emergency funds at home because she learned long ago that digital systems are not always reliable when you need them most. These are not unusual behaviors. They are the normal financial practices of a generation that built this country, and the new rules are treating them as red flags. Strategies that protect your retirement income. Right now, despite the challenges created by these overlapping pressures, there are concrete strategies that can meaningfully protect your financial position. Here is what matters most right now. If you have an RRSP and you are approaching age 71, sit down with a qualified financial planner immediately and map out your RRIF conversion strategy. Canadians who are in a lower tax bracket between ages 65 and 71, before both CPP and OAS are fully flowing, can voluntarily draw down their RRSP in advance. This reduces the RRIF balance at the point of conversion and, by extension, reduces all future mandatory minimum withdrawals. Smaller forced withdrawals mean less taxable income, less tax, and significantly less risk of triggering the OAS clawback. This is a strategy that many seniors are not aware of, but that can make an enormous cumulative difference over the course of a full retirement. There is also a one-time election available before your first RRIF payment is issued. You can choose to use your spouse's age to calculate the minimum withdrawal amount. If your spouse is younger than you, this election meaningfully reduces how much you are required to take out each year. It is a simple, legal option the government allows, but you must make the election before your first RRIF payment is processed. Once that window closes, it is gone permanently. This is one of those decisions where timing is everything, and acting early protects you in ways that acting late simply cannot. Any funds you receive from your RRIF that you do not need for living expenses can be redirected directly into a tax-free savings account. The TFSA is one of the most powerful financial tools available to Canadian seniors, and it is particularly valuable in the current environment because withdrawals from a TFSA do not count as income. That means they will never trigger the OAS clawback. If you are receiving more from your RRIF than you actually need each year, moving that surplus into a TFSA rather than letting it accumulate in a regular savings account could protect thousands of dollars in OAS benefits over the years ahead. For seniors concerned about the new restrictions on cash transactions, the most important protective step is documentation. Keep a record of your cash withdrawals and the purposes they serve. If you regularly give or receive cash from family members, ensure there is a clear, consistent, and easily explainable pattern. Talk to your bank directly about what their specific policies are for large or third-party transactions. Being proactive and transparent with your financial institution is the single most effective way to protect yourself from being caught up in a compliance process that was not designed with your specific personal situation in mind. Your complete action plan. The first step is to get informed and stay informed. These rules are evolving rapidly. What was a proposed regulation several months ago may now be in effect, and what is currently being debated may become law before the end of the year. Check in with your bank, with a qualified financial advisor, and with trustworthy information sources regularly. Do not assume that what was true 6 months ago is still accurate today. The second step is to review your RRSP and RRIF situation immediately if you are approaching or past age 71. Understand your mandatory withdrawal requirements, Explore voluntary early drawdown strategies. Consider the spousal age election before your first RRIF payment. Redirect surplus RRIF income into your TFSA wherever possible. Each of these steps has the potential to meaningfully reduce your tax exposure and protect your OAS payments over the years ahead. The third step is to understand the OAS clawback thresholds and how your income sources interact with them. Know that your RIF withdrawals count as taxable income. Know that the clawback begins at $93,454 of net world income in 2026. Know that a single unexpected income event, a property sale, an inheritance, a larger than anticipated RRIF withdrawal, can push you over that threshold and reduce your OAS without any warning. Plan proactively with a financial advisor to manage your annual income in a way that minimizes clawback exposure year by year. The fourth step is to document your cash activity clearly and consistently. Keep a simple notebook recording cash withdrawals, the amounts, the dates, and the purpose. If you have cash saved at home that you plan to deposit, organize your supporting records before you go to the bank. Withdrawal histories, records showing accumulation over time, or any documentation that explains the source of the funds. And before making any large cash deposit, call your bank branch in advance to explain what is coming and where the funds originated. This one step can prevent a lengthy account hold from becoming your reality. The fifth step is to verify that your GIS protection is in place. Your guaranteed income supplement for July 2026 through June 2027 depends entirely on your 2025 tax return being filed before April 30th, 2026, even if you have no income to report, even if you owe nothing, even if your only income is CPP, OAS, and GIS already known to the CRA. Filing is still required every single year without exception to maintain your eligibility. If you have not yet filed, call the CRA at 1-800-959-8281 or find a free community volunteer income tax program clinic at canada.ca. The sixth step is to update your direct deposit information with Service Canada if anything has changed. If you have switched banks or opened a new account in the past year, your CPP, OAS, and GIS payments could be delayed or returned if Service Canada does not have your current banking details. Update your information through My Service Canada account at canada.ca or call 1-800-277-9914. The seventh step is to use your collective voice. Advocacy organizations like CARP exist precisely for moments like this one. They are demanding that seniors, not bureaucrats, should decide how and when to access and use their money based on what is best for their own lives and circumstances. That is a principle worth defending actively, and collective advocacy from Canadian seniors has historically produced real and meaningful policy changes. Stay engaged and make your concerns known through every legitimate channel available to you. The retirement you were promised. You spent 40, 50, sometimes 60 years contributing to this country. You paid your taxes, you built your savings, you trusted the system. And now, in the years when you should be experiencing the financial security and dignity that a lifetime of work earns, you are being asked to navigate a maze of new rules, new restrictions, new reporting requirements, and new barriers, all while managing your health, your family, and the very real concern of whether your money will last as long as you do. That is not the retirement you were promised, and it is not the retirement you deserve. The changes coming to Canada's financial and banking system are not going away. They will continue to develop over the coming months and years. The question is not whether they will affect you. They will. The question is whether you will be caught off guard or whether you will face them informed, prepared, and protected by the knowledge and the planning that makes the difference between financial security and financial crisis. Stay informed, talk to your family, consult a qualified financial professional, document your financial activity. File your taxes on time every year, and never stop advocating for your right to control the money you worked your entire life to earn. No regulation, no matter how sweeping, should ever strip you of that right. If you have questions about how any of this applies to your specific situation, your RIF, your OAS clawback exposure, your cash banking situation, or your GIS eligibility, write them in the comments. Every comment is read and responses are given. This community exists to ensure every Canadian senior has access to clear, honest, and complete information about their financial rights and retirement income. If this was useful, please share it with someone in your life who needs it: a neighbor, a sibling, a friend on a fixed income. The difference between knowing what is happening and not knowing can be measured in real dollars and real peace of mind. Subscribe to stay current every time something important changes with CPP, OAS, GIS, RRIF rules, banking regulations, or any other issue affecting your retirement income in Canada. When changes happen, you deserve to hear about them clearly, completely, and without delay. Retirement Rights Canada.